Hello traders, this is my weekend video. I have a distinct feeling this is going to be a little bit longer than what I typically make. Uh, I tried to keep them around 20 minutes, but I have a feeling it's going to be longer. Real quick, what I'm going to try to go through this as fast as I can. I'm going to start with this chart here. The guy posted on Twitter. And this is the relative comparisons of performance after a major downtick in the markets like we just got through having. And you see, as of December 20th, we lost 14% in the S&P. Okay, and we don't really know what's going to happen, what's going to be the relative comparisons going forward. But I am bear, and I'm going to have a bearish bias on all my takes on my charts. I could be dead wrong, so just bear with me and listen to what I'm saying here, and we can all make some money together. But basically, you see the 13% decline, and we had an 8% decline once before, uh, and it was coupled with extremely high volume too. So basically, in the comparative on the percentage moves in the prior, uh, you know, it was actually up that, and then so that's just something to keep. I do think because we had such a massive, massive sell off so quick that the bottom is not in the markets. So I do think we had a continuation happening in the not so distant future. I just don't know how soon it's going to hit. That's my uh, thesis here. So if you have noticed here, it's pretty much all red though. I mean, the bias is negative for the first quarter of the year. Okay, we just quarter. So I'm going to start with a quarterly chart on the NYA. This is the most comprehensive view. And there's only been one candle with a greater range in history than what we just had in the past 3 months. And that was the 2008 crisis. And that was only one. In that entire crisis, we've only had one that was worse than the quarter we just got through having in the S&P at range highs. And we are trading right near critical uptrend support. Okay, so if that doesn't worry you, I mean, you I mean, I just absolutely think this is going to fail. I mean, this to me is a complete blow off top situation, in my opinion, setting up here in the markets. So what happens here? But on our quarterly basis, I think we are just going to completely. Um, we might pop up a little bit and come back in, but I do think we're going to come in lower on this. It's kind of like a head and shoulders formation here coming in, but I just don't know how soon it's going to happen. And a quick view of our yield curve. You see how we are rolling over the top here on our yield curve because now all of a sudden we're going to have lower interest rates. And the markets are not liking that too well. So just keep this in mind, what's happening with our yield curve here. It can be this way for an extended period of time, of course. So, but it's not looking too healthy for the yield curve. We are probably going through periods of actually going to have some inverted yields on our treasuries for an extended period of time here. Well, most traders like talking about the S&Ps. Well, I'm going to start with the diamonds. And the main reason that I'm starting with the diamonds is the first data hitting the tape is going to be, as of tomorrow, is going to be directly impacting our Dow Jones. And there's only 30 stocks. So just keep that in mind. Excuse me, had some hot cocoa here. Basically, what I'm seeing going on here, we have the 2017 value area. And as I said in my last video, we pinned right here. I had told you that I expected that to act as resistance. So my bias was either to be pinned or trend lower there on Friday, and we ended up pinning out. And that's exactly what, the scenario that I had mentioned. and we will see what happens. The futures right now are pointing to an even slightly higher open going into tomorrow's data. And to be perfectly honest, there is a little bit of room to go higher, even into that uh, resistance for the 2017 high, and you know, so even if we do tick up in the overnight session, I'm not going to read a whole lot into that. Okay, my bias is that uh, we're probably day one here in January. In my opinion, we're most likely to be coming down and at the very least retesting our uh, uh, 200-day monthly 125 SMA, to come back and down and retesting that to see if we can hold above it. So yeah, lots of risk. So we'll see what happens. Oh, I did want to tell you about the volume profile here. Okay. What we did, the Dow Jones lagged on the way up, and this last big explosion to the upside in 2018, it was coupled with the Dow Jones catching up with the rest of the markets. The Qs started, then the S&P, the Qs, and then the Russell, then the S&P, and then the Dow was the laggard to the upside. And what we did, we had an explosive move in 2017. And look at these values. We've got all kinds of value voids in the 2017 value profile, and we're right down here again in this void area. Okay, which can have explosive moves to the upside, but it can also revert lower in an explosive way. So I just want to point out here, we are at a resistance area with a very low volume profile support zone on the Dow Jones coming into news tomorrow. And if I go through my news real quick here, we have uh, first thing in the morning around 6:30 in the morning, we have the new car sales coming out. Okay, and that's going to have a lot of issues to do with our industrial production. Okay, that then you're going to have your red book coming out at 9 o'clock. Then you have your ISM Institute of Supply Management new orders. Okay, and we've already been told that the suppliers are at they've had uh, they're having a record low order flow for suppliers. So the ISM new order numbers are likely to be lower too. They're going to likely miss because of the low orders on the suppliers that hit Friday. And then our manufacturing PMI, which may or may not be okay, may or may they're telling us that it's really solid. So that's the most important one is our manufacturing PMI that's hitting tomorrow. And then Thursday we have construction spending, and Toll Brothers came out and they lowered guidance just last week, citing weaker than expected demands. So that's not good for that. And total vehicle sales, that's a summation of our vehicle sales hit Thursday. And then we have our crude inventories hitting Thursday also. And then Friday, the big one of the week, that's our non-farm payrolls. And we have our Fed heads speaking Friday, which is more than likely to really rattle things up a little bit. So some very important news-driven events, and we want to get into all the other stuff with Trump going on. So uh, still a whole lot of risk in the markets. Okay, I'm going to start with the Nikkei 225 Japanese markets. And in my opinion, we have not come down and retested support yet. We did have a responsive bounce so far on the monthly. So that lends me to think that we're going to have more downside pressure for sure in the Nikkei because we have not even hit the solid supports yet. We came close, but we didn't hit it yet. And look at this. We've spent, when it does come down here, it likes to spend time down here. So I just think this is a blow off top and it's coming in. And this is our 50% Fed fan, and we are still above it, so the Nikkei is still in a bullish trend. Back in 2016, value was built out down in this price range right here. So just keep that in mind. There was responsive buying at for the Nikkei down in these levels historically in the past. And I think that has a reason why we did get a little bit of responsive bounce, and we were right at the 2017 value point of control. So that's a very solid thing there. So we spent several months at this price range. So instead of just coming down here and get, so uh, I think the Nikkei is somewhat stable right here, in my opinion. Europe's a whole different story. It's in all kinds of trouble. It's actually leading, in my opinion, it's breaking support levels where the U.S. is trying to save some of its trend support levels. So we have broken the 50% fib fan on DAX and closed near the lows of the month. Not very pretty at all for the DAX, in my opinion, and lots of room to the downside. So my biggest concern is any contagions spilling over from uh, the Euro sessions. Now, uh, on Germany, we are at a trend line support right here on Germany, an uptrend monthly uptrend trend line. We are right here right now. And if you look back in 2015, the highest volume point of control was just a few cents above where EWG is trading right now. So there is some response. We are at a trend line support area, and the highest. Uh, this was an accepted area to do business in years past. So I just want to point that out. Even Germany seeing some support at these levels. In my opinion, the Shanghai Composite still hasn't quite hit support. There was some rumors out Friday there that they might be doing another round of stimulus there in China. So this is something you got to keep on watch, especially next week. I think, yeah, next week that China and Trump are going to sit down and start negotiations on the tariff issues. And so far, it seems the tone is getting a little more positive. So we'll see how the news flow comes out this week. There was a bounce point here in the past, um, but after seeing in this resolve lower like this, typically when you see a bounce pattern and then a resolution like this lower, this resolution is going to be going lower. So just keep that in mind uh, for future reference. The Hong Kong market is in a bear trend. If I were to put the fib fans on this here too, this is in a bear trend too. I tried to clean it up a little bit by not putting it on it. We're below our 50% major uptrend, and this is coming down. Bearish trend, bear flag, in my opinion, continuation pattern. So as you can see, prior levels right through here, they found rapid selling all the way down to the breakout point. So right here is my target for the Hang Seng into the first of the year. So the Asian markets aren't looking very pretty here. So just keep that in mind. Now the diamonds have been outperforming the S&P pretty much all year, started back in 2017, and the trend is still solidly to the upside. So I want to point this out here. This is the one trend, in my opinion, that is most likely to break going into 2017. It's the most risky of all the trends, in my opinion, the Dow 30. The fact that you've only got 30 stocks, of course. Um, this is the area that I think has the highest risk. Those stocks have not come down very much at all on this sell off. So if we were to get continuation in the sell off, this is the area that I do think is going to start resolving to the downside. But so far, uh, I'm using the Heikin-Ashi uh, uh, comparative strength candles, and so it's still the diamonds are still outperforming the SPY. I mean, this is not the actual price. I mean, this is not price. This is relative comparison, okay? And your diamonds are still outperforming your S&P 500. But I do think this trend is going to change in 2019. That's going to be one of my primary themes for 2019. And this is what I'm looking at. We'll see how that economic data comes out tomorrow, but look how tight the relative strength on this uptrend is holding going into day one of critical news hitting the tape tomorrow morning. That's why I'm thinking the relative strength, this relative strength indicator changes at maybe as early as tomorrow. That's because it's so close and so tight to the uptrend line. So that's the main reason I am highlighting this as a possible trend change January 1st. Christmas Eve, we did have a little bit of a comeback in on the TLT, but I see TLT continuing to have some relative strength here. Um, so just keep that in mind. Uh, I just do not see TLT selling off. I see it having relative strength in my opinion. So um, take that for what you want to think. That means it's a safety haven because we have. I think the markets are going to factor in one more rate hike until proven otherwise, and so at least in the next short term or what have you, they're going to keep artificially inflate TLT for the near term. Another major theme that I'm expecting in 2019 relative the relative strength in the Qs versus the SPY to come in. So, say the markets go flat or whatever I see the SPY having less strength than I do see the S&P 500. Okay, so this is in my opinion, we have moved to the later stages of the economic cycle, and that means that you're going to have your consumer staples, you're going to have your utilities, you're going to have your healthcares. They're going to be the ones leading any markets higher in generally from here because we're at that stage of the life cycle or the economic cycle. At this stage, the technology stocks start lagging. Okay, we've seen this many a times at the first of the year, and this happens. So just keep that in mind. Relative weakness starting to firmly entrench in the Qs from here on from January 1st. Now, in that same theme, our FANG stocks have just been absolutely on fire. And those are the ones that there's only basically 5 stocks that took the NASDAQ for 2, 3 years. It was unreal how they were just driving force on the NASDAQ. So if the Qs do manage to start underperforming the S&P, the FANG stocks will most likely be leading the way to the downside. And I want to point out here on a relative strength indicator, we are at a typical range high for the FANGs that for relative strength wise that we should likely back off from here versus the Qs. So basically, starting January 1, my thesis is that if the Qs do have a bid under them, the FANGs should not be the leadership board. Okay, so we'll see what happens here at the first of the year. I know a lot of people love Amazon. I mean, they just think it's going to go back up to $2,500 and stuff. But I'm saying that if we are truly later in the upcycle, that the FANG stocks will underperform from here on out. Okay, typically I would show you the SMH versus the Qs, but pretty much they're trading in parity. They've been that way for a while. Okay, so whatever the Qs are doing, the SMH is doing. They're just trading in tandem right here. Okay, so I went out SMH versus the SPY, and you see this trend. That's not really a trend line. But you see what's happening right here. we are starting to see more relative weakness in the semiconductors versus the SPY. And this is one of my leading indicators that the Qs are going to start uh, rolling back over here. And here on January 1, this trend of all trends out there is likely to be the first to break down, in my opinion. So just keep this in mind. This is what to watch. Semiconductors really look like they're going to be weak the first quarter of this year. IWM has a big problem with the high yield bonds. I mean, if the high yield bonds start to recover, SPY, uh, this is another thing you got to got to check right here. We are potentially crossing over our downtrend line on the daily. So, maybe I forgot, I guess, a little bit on that, but high yield is the key though, and we are at 2016 lows on our value point of controls. Let me show you what I'm talking about there. Area. So this is technically a responsive buy zone for IWM, in my opinion. All depending on high yield bonds. So if high yield bonds start to improve, this is a buy zone, but we'll see how the markets do that. So I'm bearish to markets, so I'm not going to do it, but this is the support buy zone for IWM. We have a little wedge pattern that we've come crashing down to for our industrials, and we're right down here at the 2017 value area lows on our industrials. So that's something to keep on the radar here, that if we start breaking down, if we go back down again below this wedge formation, then that's very bullish for the markets, or very bearish for the markets. So just keep that in mind, the situation. And like I said, we have that manufacturing PMI, or manufacturing orders coming out tomorrow, and we are putting in a bear flag until proven otherwise. And so we are bear flagging here, coming into critical data that's hitting the tape tomorrow on a relative strength basis. So yeah, this is something to really be aware of, that we're coming right to the end of it, and depending on how that data goes tomorrow, we're going to have an explosive move in our industrials. I'm still leaning to the downside, but I will hear the news and go from there. And the last major sector I wanted to talk about, and that's your transports. And I did put on a CSX, some CSX puts coming into tomorrow. I could be wrong, of course, but if that data, if the reaction to the data is as I think it's going to be on January 1st, then I actually think we're going to be coming right back down to range lows here on our transports versus our industrials. Because if they come in, say, we've already had on the supplier side reports that they're needing far less, that there's a lot less order flow coming in, and there's inventory builds. So if that verbiage comes out again tomorrow, and coupled with, if they come out with weaker sales forecasts, then it's going to be extremely negative for our industrial this correlation pattern, and it's even going to be more so for the transports, in my opinion. And if you go out on the monthly here, you can see the transports pretty much flat. They've been, well, this correlations, they're in parity. So basically, if the transports go down, the industrials are going down too. And sometimes there are periods in time where the transports are selling off harder. That's whenever it's coming down. In other periods of time where the industrials are stronger versus the transports. That's the only way this moves. But this is more of a parity trade in the long term. But in the short run, it does look like, in my opinion, the transports are still going even lower. Okay, and that's all I'm going to have to say. I'm going to edit some of this stuff out. So uh, I'm bearish. I'm sticking with my thesis until proven otherwise. So good luck. Leave comments below. Like it if you like it. If you have legitimate reasons to think that I'm wrong, I mean, be sure and make comments down below. I'm more than willing to entertain your thoughts. I trade both sides of the markets, so even though I have a bearish video, I will have some call trades on too. So, uh, good luck and good trading.